What's up, good people? Welcome back to the channel. Following my recent series on stock investing basics, I think it's time to graduate and move on to stock trading. So I have decided to put together some content on stock trading for beginners. Not a sleazy sale of any online course. This video is absolutely free and aimed at beginner traders to help kickstart your trading journey. If you've always wanted to learn trading but have no idea where to start, or you lack experience, this is for you. The idea is to keep things simple, walk you through step by step on everything you need to know about stock trading as a beginner, from how to navigate the stock market, perform technical analysis, different trading methodologies, price action based strategies, how to read charts, and all of that good stuff. So hopefully by the end of this series, you will be fairly confident to place your first trade. Sounds good? Let's dive straight in. I'll kick off the series with some introductory topics like what trading is in general and some of the key trading terms you should know. And I'll slowly introduce more meaty topics in the future videos. So on that note, let's get down to some basics. First things first, what is stock trading? Now, there are a couple of ways to play the stock market game. One is by investing, that is buying and owning the assets or stocks for the long term. I have a series on this already. I'll leave a link down below if you're interested. And the other is stock trading, speculating the price movements. So in this, you would buy and sell in short intervals, trying to profit from every swing in the market. For instance, you buy a stock now, and if the price goes up in the next few minutes or hours or days, you sell it. Well, there are different types of trading styles based on frequency, which we will look at later in this video, but you get the gist. So you're basically predicting if the price of a stock will rise or fall over the short term. That's essentially what stock trading is. Now, before we move on, let's quickly look at various asset types to trade in. So now you can trade in multiple asset classes. Here are some of the common ones. Shares or stocks, also called as equities, the most popular one. This is what I'll be covering in this series. But just so you know, you could also trade in bonds, also known as fixed income, foreign exchange or trading of global currencies. Then you have commodities, that is trading of various physical assets and raw materials like metals, agricultural products, crude oil, etc. You could also trade in indices or group of assets. Examples would be S&P 500, NASDAQ, FTSE 100, Nifty 50, all of that. While basics of trading remain more or less the same for most asset types, trading strategies and trading styles can vary significantly. So that was just for your information. Like I said earlier, in this series, we will be focusing only on stock trading. I'm going with the assumption that you know what a stock or a share is. But just to summarize, a stock or a share, which is one and the same, is a unit of ownership in a company. When you buy a share, you become a shareholder, basically a part owner of that company. I hope that's clear. And with that out of the way, let's get down to some basics on stock trading. First, let's look at how shares are traded. Shares are traded on a stock exchange. That's just a marketplace where shares are bought and sold. For example, most US shares are traded either on New York Stock Exchange or NASDAQ. Similarly, most UK shares are traded on London Stock Exchange. And then there are European stock exchanges and also Asian stock exchanges, for example, BSE or NSE in India. A publicly traded company can list its shares on more than one exchange. As an example, here you can see Unilever is listed on 6 different exchanges between Europe, UK and US, and the price of the share is reflected in the local currency of the exchange. I hope that's clear. Moving on, let's look at who is involved in trading and who are the market participants. At a very high level, there are 2 types of market participants, traders and market makers. Broadly speaking, there are 2 types of traders. Institutional traders like retail banks, pension funds, mutual funds, hedge funds, insurance funds. These are large-scale players who manage pool money on behalf of individuals. And then you have retail traders. These are private individuals like you and I who trade using personal accounts in relatively small sizes. The second type of market participant is market makers. Now, have you ever wondered what happens if you want to buy a stock but there's no one selling it? Or you want to sell but no one's buying? Well, fortunately, that situation is uncommon thanks to market makers. So market makers are appointed by the stock exchange to inject liquidity to ensure there is enough volume of trades so trading can happen seamlessly. This means there's always someone to sell or buy a stock. Market makers are generally investment banks, Goldman Sachs, Morgan Stanley, Barclays, UBS, and the likes. Since all stocks traded on an exchange are ultimately bought and sold by market makers, they charge a spread on bid and ask price for this service. Let's quickly understand what bid and ask price, as this is quite important for you as a new trader. So, bid is the price that you would sell a stock at, essentially a sell price. And ask is what you buy a stock for, in other words, buy price. Bid or sell price is always lower than the ask or buy price. So essentially you pay more to buy a stock than you would receive if you sold it. This difference between bid and ask price is called the spread. It is charged by market makers for facilitating the trade volume and keeping the markets functioning by always being there to buy and sell a stock. So it's a win-win. Next, where to trade stocks? Let's look at a pictorial representation. So you are a retail trader and here you have different stock exchanges. But how do you go about trading? In order to trade in stocks, you need a brokerage account. The broker acts as a middleman between you and the stock exchange. You can open an account with one of the many online brokers available in your country of residence. It's fairly simple and easy to open a brokerage account these days. Most brokers offer a simple signing up process where you're required to submit certain documents online. Once that's verified, your account will be activated. Then all you need to do is deposit some money into your newly opened brokerage account using a debit card or a bank transfer, and you are good to go. I hope that helps. Next, let's look at some of the key trading terms: going long and going short. There are two sides to a stock market: going long and going short. The most common type of trading, and I'm sure you're familiar with this, is buying a stock when you anticipate a price rise and then sell it when it reaches your target price to make a profit. This is called going long. In a long position, you take ownership of the stock you're buying. Buyers who go long are called bulls. The second type of trading is going short. This is when you sell a stock that you don't own. If a trader believes the stock price is set to fall and they have no position in that stock, then they can open a short position and buy back the share at a lower price to make a profit. The traders who go short are called bears. If you're new to stock trading, this type of trading might seem a bit odd, as logically you need to first own a stock in order to sell it. But in fact, selling a stock that you don't own is possible in stock trading. This is called short selling, and it's legal in many jurisdictions. Short selling is believed to drive stock prices more efficiently and mitigate market bubbles and financial fraud. But I must remind you that short selling is not ideal for new traders, and it's a topic in itself. I intend to cover more of this in a separate video in the future. But for now, all you need to know is some basics. So just to reiterate, if a trader anticipates a stock value is set to fall, they borrow that stock from a broker, sell it in the market, hoping to buy back later when the price drops, and return the stock to the broker. To open a short position, you must have a margin account where you pay collateral or initial margin plus any interest on borrowed shares to the broker. This is different to your regular brokerage account you would use to do long trading. Next, let's look at different trading styles for retail traders. There are 4 main types of trading styles based on trading frequency: scalping, day trading, swing trading, and position trading. In scalping, you would execute numerous trades throughout the day. A scalper typically holds a position only for a few minutes. The objective here is to take small but frequent profits. This style is suitable if the markets are showing strong trends and are extremely liquid. But this requires very good knowledge of technical analysis and is very time intensive. So I wouldn't recommend this style to a beginner. Next is day trading, also known as intraday trading. This involves buying and selling a stock within the same trading day. Day traders capitalize on intraday price fluctuations. The main trait of this style of trading is that day traders close all their positions before the markets close each day, either for a profit or for a loss. So they don't hold their trades overnight. While day trading is less intensive than scalping, it still requires you to be on top of your game with your strategies and requires a lot of focus and dedication, and therefore not suitable for beginners or part-time traders. Third is swing trading. This involves holding a position over a few days or weeks. The goal here is to spot a trend and capitalize on the dips or highs. This style relies heavily on technicals as well as fundamental analysis to identify stock candidates. Typically, a swing trader will wait until a profit target is reached to close a position. So it can be as short as an hour or as long as few days or even a week. This style of trading is relatively safer for new traders and part-time traders, as you don't need to monitor the market all day long. But it's crucial to identify correct entry and exit points, or you may end up holding the stock for much longer. And the last type is position trading. This is a long-term approach, more or less like investing, except that investing always adopts a buy and hold strategy, whereas position traders may hold stocks for a few weeks, months, or even years, trying to capitalize on the overarching price trends. While this form of trading does not require extensive market monitoring on a daily basis, it certainly requires thorough fundamental and technical analysis both while entering and exiting a position. But this type of trading is beginner friendly and is suitable for part-time traders as it's less time intensive, and it can be combined with a day job as well. So those are some of the key trading styles for retail traders. The difference between them is merely theoretical, and there is nothing stopping you from having a flexible approach of adopting a mixed style if you wish. For instance, if you feel ready, you can scalp certain stocks while position trade some others. And now on to the last segment of this video, type of trade orders. But first, what is an order? An order is simply an instruction to open or close a position. Let's do it together. This is my trading account. Let's search for Amazon. Let's say I want to buy 50 shares at $90 and I place that order. So this is what my trade order looks like. There are three most common types of trade orders: market order, limit order, and stop loss. Market order is an instruction to buy or sell a stock instantly at the best available market price. Here you can't specify a price. Let's go back to my trading account. Let's bring up Apple this time. So if I want to buy 20 shares at the current market price, I just set a market order and it will get executed instantly at this price. This is essentially market order. Next is limit order. Limit order is an order to buy or sell a stock at a price specified by you. Continuing with Apple, I still want to buy 20 shares, but this time I change this to limit order and specify a price that I want to buy the stock at. Let's say I want to buy at 155. Now this order will execute only if the price of the stock falls to 155 or lower. Further, a limit order can be a day order or good till cancelled. Basically, you define when you want the order to expire. A day limit order will be active until the end of the trading day or until the specified price is achieved, whichever is earlier. And good till cancel order will remain open until the specified price is achieved or until you cancel it, whichever is earlier. So continuing with Apple, if I still want to set a limit price at 155 to buy, and if I choose the expiry day as day order, and if the price does not fall to 155, then my order will be auto-cancelled when the markets close today. However, if I set the expiry to good till cancelled, my order will remain open for however long until the stock falls to 155 or until I manually cancel it. I hope that's clear. The next type of order is stop loss. This order is designed to limit the loss on a position. There are two types, basic stop loss and trailing stop loss. Let's first look at an example for basic stop loss. Suppose you bought Tesla shares at $195, hoping the price would go up, but you also want to protect your capital if the stock declines. So you set a stop loss at 175. Let's say the stock actually starts tumbling. So if and when the stock hits 175, your stop loss order will be executed. This helps you minimize your losses against an unexpected falling stock when it tumbles much lower. Now, with trailing stop loss, instead of setting a specific price, you set a trailing percentage below the market price. Back to Tesla. Suppose you still have shares at 195 and here you set a 10% trailing stop loss instead of a basic stop loss. In this case, if the price falls to 175.5, that is 10% of 195, the stock is automatically sold as the price has dropped 10%. However, if the share price rises, the trailing stop loss rises with it. So if Tesla stock rises to 220, your trailing stop loss at 10% will execute your sell order if stock price dropped to 198, that is 10% of 220, instead of 175.5 previously, allowing you to lock your profits. So if you didn't have a trailing stop loss in this instance and the price fell back to less than your purchase price, you would have lost your chance to lock any profits. Essentially, a trailing stop loss locks in the upside while protecting you from the downside. Right, I think we've covered enough for an introduction. So now, while I get cracking with the next topic, I have a task for you. You could put today's knowledge to use by opening a demo account with any online broker of your choice, which will allow you to practice trading. It's called paper trading. You don't need to deposit any real money. It's basically a practice trading account that aims to recreate the experience of real trading as closely as possible before you spend any real money on trading. I would encourage you to sign up to one if it's available in your country of residence. Well, I really hope you found this useful. Good luck and see you very soon.